Welcome back to another video here on the channel. Today I want to discuss different buying strategies of Bitcoin like lump sum investing or dollar cost averaging. What are the differences between simply holding and trading, also on a tax level, and also what are the best exchanges for each purpose, and what are the differences between the real Bitcoin and trading CFDs. So we have a lot to cover. Now let's get right in and talk about the distinctions between holding and trading, because what you choose influences everything else, from taxes to the available strategies to the best exchanges. I'm not a financial advisor and not a tax advisor either. This is purely educational content. Always do your own research and talk to your certified advisors. Holding Bitcoin, which is often referred to as hodling Bitcoin, means buying the orange coin without any plan to sell it in the short or medium term, or maybe never, depending on your conviction. Hodlers usually move their coins from an exchange into cold storage like a hardware wallet to have self-custody of the asset. They don't plan to sell it, so why risk having it on an exchange that could go broke or get hacked? Historically, simply holding Bitcoin has been an extremely successful strategy, as you can see in this table. If you held through a 4-year halving cycle, your Bitcoin has certainly gone up in value. And there are two different ways to become a Bitcoin holder. One is a lump sum investment, which means you invest all the dollars or euros at once and then never have to think about it. Say you want to put $1,000 into Bitcoin. A lump sum investment would mean you go to an exchange and then buy Bitcoin once for $1,000. What I prefer though is dollar cost averaging. Instead of buying it all at once, you set up a plan that buys Bitcoin daily, weekly or monthly. Your $1,000 could be stretched to 20 weeks of $50 per week, for example. Why does that make sense? Well, you get rid of some of the volatility. Say you buy Bitcoin once and then the next week it's down by 30%. It would be nice to buy some more Bitcoin at that point in time. Dollar cost averaging gives you, as the term suggests, an average. And of course, the average can be better or worse than the lump sum buy. You can also combine the two strategies by buying $500 worth of Bitcoin at once to get an initial exposure and then set up a weekly or monthly plan for the other $500. Holding is a long-term strategy, which means you need to be unfazed if Bitcoin is in a downtrend. Other than that, it's very simple. You just buy and then do nothing. You just wait, whatever happens. So what about taxes? Well, I can't give you an all-encompassing answer here because it depends on where you live. What I can say is that in most countries, holding Bitcoin for the long term is less of a taxable event compared to trading. I give you Germany as an example. If you buy Bitcoin and hold it for at least 1 year, selling it actually is completely tax-free. There is no tax on the gain. If you trade, on the other hand, every currency switch is a taxable event with up to 45% of income tax. More on that later. The best Bitcoin-only exchange is probably Swan Bitcoin. It makes dollar cost averaging extremely easy and has an auto-withdraw feature, which means you can send the Bitcoin you buy each week or at a certain threshold automatically to your hardware wallet. Swan also has very low fees for these plans compared to Coinbase. And what I find really awesome is that they take the holding strategy to its natural conclusion. Swan Bitcoin has no sell button. You can only buy and send your Bitcoin to another address. You cannot sell Bitcoin on this exchange. Other good exchanges for hodlers are River, which unfortunately is US only, and Relay, which is available in Europe. You can also use a DEX, a decentralized exchange like BISC, for buying Bitcoin. These exchanges don't really work for trading as they are too slow and lack proper liquidity, but for hodlers they are great and don't have know your customer guidelines, which helps your privacy. Now let's get to trading, which is quite the opposite of holding. It has more of a short-term focus. Trading can definitely beat hodling, but it can also get beaten by it. It depends on your skills and your luck. Most traders are actually just gamblers in disguise, but this doesn't mean that there are not a few who really know what they are doing. Traders use information they can generate through technical analysis and on-chain analysis to make calculated bets if an asset will go up or down in the future. They also have stop losses, which means they sell their position in case it drops to a certain point, while a hodler will just hold through it. Trading, of course, takes a lot more of your time compared to holding and is an active process rather than a passive one. If you choose to become a trader, this decision results in different taxing and a different exchange you should sign up for. Now coming back to the topic of taxes. Again, it completely depends on where you live. I'll give you Germany again as the example. As I said, holding Bitcoin over a year makes selling it a tax-free event. It's comparable to selling art or other valuables. What about short-term trading? Short-term meaning everything below 1 year of holding. In case your profit for the whole year of trading is below 600 euros, the profit is tax-free. If it is just €1 above it, the whole profit underlies the income tax, which depends on your total income and is between 18 and 45%. But what happens if you buy Bitcoin regularly? how do you know if you hold it for over 12 months? For that, the first in, first out method is applied. Say you buy 1 BTC in 2019 and 1 BTC in 2021. Now you sell 1 BTC in October of 2021. The profit would be tax-free in Germany, as you essentially sold the BTC you bought in 2019, which is more than a year old. First in, first out. Popular exchanges for traders are Binance, which is the biggest one, Kraken, FTX, and many more. The features and fees of these are quite similar. Some have slightly better fees, other ones offer more trading pairs or coins for staking. One difference in how you buy Bitcoin is if you buy the actual coins that you can send to your own wallet, or if you trade a Bitcoin CFD, a contract for difference. In the latter case, you bet on the price going up or down by taking long or short positions, but you never own any actual Bitcoin. This has a different tax impact in most countries. In Germany, instead of the income tax, it triggers a settlement tax which is fixed at 25%. So it can make sense for traders to use CFDs instead of buying and selling actual coins from a tax perspective. What's my conclusion? Well, I'm a hodler, so I might be biased here. To me, holding Bitcoin is an investment, while trading Bitcoin is a job or a gambling hobby. It can be fun to do and also create immense success, but I'd rather stick to the basics with passive dollar cost averaging, and the elimination of the income tax for hodlers in Germany is a fantastic add-on as well, which makes my strategy a no-brainer to me. And that's it for this video. Thank you for watching. If you enjoyed it, I would appreciate it if you leave a like and subscribe to the channel for further content, and then I see you next time.